Today, we're going to dive back into the world of finance TikTok and look at some people talking about buying stocks. Will they do a good job or will it be a disaster? I'm betting on disaster, but there's only one way to find out.
Here's 3 stocks that I'm buying this month. First stock is 3M Company. Stock price is as low as it was 10 years ago, and they're also a part of the Dividend King, so they're going to give you a nice dividend growth long term.
First things first, did he say anything that is interesting? No. Everything he said was well-known public knowledge. He's like, wow, this old company that's known for dividends will probably pay a dividend and their stock price is low, but anybody can look up a stock price. There's nothing special so far about what's been done. Additionally, dividends are a little overrated, to be blunt. People are like, ooh, passive income. I just get money from the market. Sure, you can also sell a company that doesn't have a dividend, like Berkshire Hathaway, and oh look, you freed up money. Additionally, if you have a stock in a non-retirement account and it pays a dividend, you pay taxes on it. If the company was able to reinvest into itself and not pay a dividend and focus on growing, you might get a capital gain on your stock, but you only pay capital gains tax when you sell. This is why Berkshire Hathaway under Warren Buffett does not pay a dividend, because it causes taxable events for the investors. Now, obviously, if you have all this stock inside of a retirement account, you're not as worried about taxes. But again, for the non-retirement people here, dividends aren't necessarily a good or bad thing. It's just a way companies can pay you money.
Second stock is Johnson & Johnson. They have something going on with the lawsuit, which caused the price to kind of go down a little bit. I'm using this as a buying opportunity.
This person is saying buy Johnson & Johnson stock because there's a lawsuit right now and the stock price is low. He did not provide any analysis of that lawsuit. He did not explain why he believes that lawsuit will turn out fine for Johnson & Johnson. The logic he's pitching right now is big company, low stock price is a good buy. This approach seems to show up in his previous stock pick as well. Big company, low stock price, it's not great. It's not great. I could make the same argument, by the way, for Silicon Valley Bank. I could make the same argument for Enron. Lots of big companies go to zero. Lots of big companies also underperform. I'm not saying Johnson & Johnson or MMM is going to go bankrupt, but they could still do bad. One more quick note, a friendly reminder for all investing. When it comes to buying an investment, the quality of the company doesn't necessarily determine whether something is a good or bad investment. Rather, it's the quality of the company relative to the price you're paying. If you pay $1,000 a share for Apple, that's a bad investment. Apple is currently trading around $150 a share. If you could pay 10 cents for stock in Credit Suisse right now, which is getting bought out by UBS, at that low of a price, you would probably make money. Credit Suisse is literally failing right now. Apple seems to have a bright future, but because of the price, the bad company is a good investment, and the good company would then be a bad investment.
Third stock is PG, Procter & Gamble. This has been getting hit pretty badly the past month. This is a good buying opportunity, and they're part of the Dividend King, so you're going to get that consistent growth along with the dividend pay.
All right, this guy's takeaway is simple. If a company is big and pays dividends and is at a low price, you buy it. Novel. Man, he is a stock picking god. I could never program an algorithm to just find big companies at a low price and buy them. I could never teach a 5-year-old to find large companies and buy them and just make sure they're on a list of dividend kings first. I could never do that. I couldn't teach a 6-year-old how to go through a list of stocks that pay dividends and find ones that are at 10-year lows. I could never do that. Man, that analysis stock picking TikTok is delivering. I give this 2 thumbs down and give it a kindergarten level of insight. Also, friendly reminder, index funds for the average investor is the best way to invest. Buy everything so that you don't miss out on the next Apple, the next Tesla, and then spend your time on other endeavors. Get into real estate investing, start a small business, start a side hustle, to pick up a part-time job. Those are all more reliable ways than going up against experts and algorithms in the stock market. If we look at the title down below, it's a little hidden here. All right, this person wants you to follow their callouts on Twitter. Okay. And we have this nice little text here. Is this good starting with $1? All right, beautiful. Look at that number. Oh my gosh, look at those gains. Look at those gains. Wow, for $1. for $1. Unbelievable. Let me go ahead and explain to you guys all what the problem with that is. I can easily do that. Actually, if you're watching this, I can teach you how to do that. Go buy some penny stocks, take $1,000 and buy 1,000 of them. Just buy 1,000 individual penny stocks. Make sure you go to a place that allows fractional shares. And I promise you, maybe not promise you, 99% chance, there's not many guarantees in the finance world. I'll give you a 99% chance by the end of it, you can produce that video. Because one of those 1,000 companies will probably have a good couple weeks. Most of your money will probably go down, but that $1 investment might do great. And if it doesn't work, just try again. Just keep dumping in $1,000 into 1,000 penny stocks at $1 a piece, and I promise you eventually you'll get a beautiful graph like that. Now, I'll be honest, that's a really stupid video. That literally is preying on people's desire to grow their money quicker than is realistic. A realistic way of growing your money is doubling it every 7 or so years. That's not that exciting, particularly at the beginning, because you don't have a lot of money to double. But that is roughly what you can get from the S&P 500. It returns about 10% every single year, though some years are down 20%, other years are up 30%. And with the rule of 72, take 72 divided by the interest rate you're getting, it'll tell you how fast an investment will double at that interest rate. 72 divided by 10, 7.2 years is the rough doubling. But still, if you have many doublings in your investing lifetime, your money can really work for you, right? If we are doubling every 7 years and you plan on working for 42 years, you get 6 doublings. $1 doesn't sound like a lot at the beginning, but you double it to 2, then 4, then 8, then 16, then 32, and then 64, and you're doing great. That is realistic. That is within reason. This stupid video is you create these videos by buying a ton of useless stocks and hoping one pays out well, take a 9-second video, maybe you edit the web page a little bit so it looks really good, and then you're good. That's it. I give this 3 thumbs down with a failed lottery ticket lurking in the background. All right, next. Now, I'll be honest. I'm optimistic about this one. I've run into Your Rich BFF a couple times now, and I err on the side of this person actually knowing what they're doing. They say they have a financial background. That's great. This is my optimistic pick. Now, this could end up being a dumpster fire. I've not seen any of these videos, but I am optimistic about her. Let's take a look.
Everyone tells you that you should invest, but never actually tells you what to invest in. So I will. I'm Vivian, your rich BFF and your favorite Wall Street girly, and here are 5 amazing index tracking ETFs that'll help you grow your wealth.
Okay, good. Where are we at right now? We're at index funds. We're not trying to stock pick and be like, big company good if it's at a low price and pays dividends. We're on the index fund train. Now look, there are a lot of crappy index funds out there, and there are a lot of great ones. I would argue it's more important to know what makes a great index fund than to learn what the name of a hypothetical good index fund is. But there is value in just telling people some good names. It can give you something to look into and compare against. Additionally, it can turn you on to some great index fund providers, whether it's mutual funds from like Fidelity or Vanguard, or ETFs from Charles Schwab, BlackRock through their iShares brand, State Street for their Spiders brand, Vanguard, etc. So there is value from this. I really hope she mentions, though, why they're good. What makes these ETFs good, and what kind of investor are they suited for? Great. All right, optimistic here. Still, my optimism's still riding high. Let's see what we got.
First up, VTI. This is an ETF that tracks the entire U.S. stock market. It's like a buy one, get everything included kind of deal.
Great summary. Love that. Also, for the record, I am invested. This is one of my 2 ETFs I invest in. 55% of my portfolio is in VTI because roughly 55% of the world's stock market, the entire world, is U.S. stock. The USA has a huge stock market. So VTI, like it, super biased. I do invest in this ETF.
You're essentially making a bet on America.
Yep.
USA. Up next, VOO. If you don't want to invest in every single stock in the U.S. equities market, but instead just the 500 largest public companies, this is what you buy. It's historically been the gold standard.
Great. Love that. It's true. Fun fact, I actually started out with S&P 500 ETFs, started out with SPY, then I moved to VOO, which had a lower expense ratio, and then ultimately I settled on VTI because I want full diversity. This past decade has been good for large companies in the USA, but that might not always be true. If a law changes, for example, that taxes large companies more than smaller ones, small companies might get better growth in the long term. VTI buys up everything. I do want to note, you typically won't see a good portfolio have both VTI and VOO in them. They're very, very similar indexes because most of the US stock market is made up of large companies. So the top holding, for example, for VTI and VOO is in fact Apple.
Third, VXUS. This is an international stock ETF that lets you essentially invest in foreign companies, which gives you a little diversification in your portfolio in case we were wrong about that America bet.
All right, super biased here, super biased. I did not preview this, and I just want to give 2 thumbs up because that's my other ETF. My whole portfolio is 55% VTI, 45% VXUS. I love the Vanguard brand, a little biased. I used to work there, but they're so dedicated to fee cutting. I would rather invest in those ETFs because I don't believe Vanguard will ever raise the fee on me. If anything, they'll lower the expense ratio even more. At a 55-45% ratio, I basically buy up all the world's companies, and I can devote all my time to other activities. I don't need to worry about picking the right stock. I own them all. Between the 2 funds, you end up with over 10,000 different companies that you're invested in. So I am likely invested in the next Apple, the next Tesla, the next Exxon. I'm invested in everything, include all the losers, but also, more importantly, all the winners.
Then there's VUG. This is a growth ETF, essentially a basket of stocks expected to grow quickly. And it's a little riskier than something like a VOO or VTI, but with a little extra risk could be a little extra reward. And
here's the problem with that. That is not quite right. Yes, there is risk. You're making a bet on growth companies. These are typically tech companies and not things like banks that are more mature. The finance industry, for example, is known to be more associated with value. But here's the deal. Growth over the long term has not been shown to significantly outperform the rest of the market. There are factors that at times do indicate historically to increase your rate of return over decades, not year by year, but decades. It takes a long time for the factors to show up. There are factors that can do that, but a number of them aren't easy to purchase into. Additionally, really capturing it is difficult to really find a fund that fits the criteria. The factors that are capturable are small companies, value companies, and they have to be profitable. But funds that prioritize that are very, 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 very rare and often can come with a high expense ratio that may drag down the overall performance to where that tilt isn't worth it. Tilting towards growth, though, you are making an active bet on typically tech companies and other growth-oriented sectors. But the idea that you're going to really grow more over the long term is doubtful at best.
last, VT, it's a total world stock ETF. If you wanted to invest in the US and internationally, you'd buy this.
All right, VT is a fine call out. The reason, for the record, I buy the total stock market, total international stock market separately is that they're so popular, the fees add up to being a little bit lower than buying VT and just having one fund do it all for you. But if you wanted one fund to do it all for you, VT or another world stock index is certainly worth looking into. Overall, I give it a thumbs up. I think that the growth really stands out as a bit of a cop-out. I see the logic behind all the other offerings, and I think the explanations were good for the rest, but the growth index really stands out as a red flag. People will pursue it because they think, oh, I get more growth from it, which isn't historically very accurate. This past decade has worked well for tech. I bet growth is doing great, but over decades, and the fact is you will probably be investing over decades, that isn't actually a factor that leads to more growth in your portfolio. Growth companies don't have that association, ironically. Additionally, we're coming off a decade of really good growth in growth ETFs in the tech sector. So that next decade, that might not be there. As price discovery occurs and as people get a better feel for what a tech company is worth, the next decade might not have some great performance from companies like Google and Apple because investors have appropriately set their expectations. Overall, though, again, just a thumbs up. Question from the chat. Does buying VTI and VXUS not double up your international exposure because VTI is the total market? Great, unbelievable question. One of the issues in the world of investing is naming things. When you hear total stock market, it implies it's actually just talking about the US stock market. If you want to see the world bought up, it's going to reference world stock market or something along those lines. This is why it's so important to make sure you read about the fund before you invest into it. The names sometimes are very misleading. VTI is just US companies. VXUS is everything but the US companies. Weird, but that's how it works. Next video, we're going to look at this. This is apparently related to Warren Buffett, and I think Warren Buffett is a fascinating investing figure because here is a godlike stock picker, somebody who makes every stock picker's heart beat a little bit faster. But the kicker is he recommends for the average investor to just buy an index fund, an S&P 500 or a total stock market fund. But sometimes I see Warren Buffett's advice and ideas twisted for the average person to indicate that he wants you to invest via stock picking. He doesn't recommend that for the average person. Let's go ahead and see what this TikTok does, though, with what Warren Buffett says, and whether this TikTok steers people towards stock picking or doing what Warren Buffett says, which is buy an index fund.
Do you have any stock tips for me?
Well, just between you.
Yes. It'll be our little...
The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them, but they don't have to, because if they can buy all of America through an index fund. And then they just have to be sure they don't jump in at exactly the wrong time, and they won't know what's exactly the wrong time. So therefore, they should put their money in over a period of time, and they'll have some periods that are wonderful and some that weren't so good. But overall, they will do fine over.
Oh, that feels so good. Unbelievable. My soul feels justified and vindicated. And 6,000 thumbs up. I'll even like the video. I love it. I love it. Oh my goodness. Oh my goodness. That is right. Thank you. Thank you. Thank you. I had low expectations. Let me explain. I had rock bottom expectations for this. Feels good. Feels good. Thank you. 6,000 thumbs up. Making sure that people understand, like, going out of your way to give a good clip of Warren Buffett to remind people that even maybe the best stock picker on the planet doesn't think the average person should be stock picking is great. Is great. Do you know better than Warren Buffett? Do you know so much that you will not be considered an average person in Warren Buffett's eyes? The answer is no. There's probably a handful of people on the planet who meet that criteria. So you might want to really consider before jumping into the stock market whether it's right to ignore Warren Buffett's advice. Index funds are phenomenal. Love them. Love them. Thank you, person who made this, for doing such a nice job. I wish more people would take Warren Buffett's clips and use it in this context. It's so good. So good.